3,000, 3,000, 3,000, 3,000. It's also important for you to note that if, for example, we are depreciating an asset at the rate of 25%, for you to be able to know this depreciation will be provided for how many years, you can take 100% and basically you divide that with 25%. So this one will give us 4 years. So if you are depreciating an asset on straight line, you provide depreciation for the next 4 years. Sasa, yes. And that's why, for example, if you add this, it will give you 12,000. Sasa, yes. So then to this, after adding back the depreciation, we then proceed and we less the wear and tear. The wear and tear allowances, wear and tear allowances. Now, this particular wear and tear allowances, for example, maybe those who are doing PFT, we also refer to them as, generally, we can also refer to them as capital allowances. We can also refer to them as investment allowances. I'll say that these are allowances which are computed, or these are basically allowable expenses which are computed as per the rate or using the rates which are issued by Kenya Revenue Authority. So how do we compute this particular wear and tear? Remember, financial statement required to compute what? The relevant. In other terms, you're required to compute the temporary what? The temporary differences. We're required to compute the temporary differences, the TD. So what is just important here for us to remember is how do we compute the temporary difference? How do we compute the temporary difference? So in this case, we know to compute the temporary difference, to compute the TD. So we just take the carrying amount minus the tax base. Minus what? The tax base. So what we just need to do is to go through the information which are given in this particular question from actually note number 1 all the way to note number 5. We are given various items of assets and liabilities. So what we need to do here is just to identify the carrying amount, to identify the tax base, and then we get the temporary difference. So in this case, we have to come up with a table here. In our table, we will have a column for the assets or liabilities. We are given from note 1 up to note number 6. The next column here will be for the carrying amount. For the carrying amount. The next column will be for the tax base. And the last column here will be for the TD, the temporary difference. Then if you check the values which are given, I think in note 1, 3, 2, 3, the values they are given in million of shillings. So we will indicate up there that all our values will be in million of what? In million of shillings. We need to indicate up there that our values will be in million of shillings there. Yes, so we just need to go through that information. I'll basically be able to guide you, to give you a number of notes here, a number of notes in terms of how to determine the carrying amount, how to determine the tax base of the various items of asset and liabilities. Because in this case, automatically you're not given those carrying amount, you're not given those particular what? Tax base. Let's go to note number 1. In note number 1, you're told inventory is stated in the financial statement at the roll of cost, the net realizable value. The company wrote down its inventory by 120 million to a net realizable value of 1130 million. The reduction in value is ignored for tax purpose until the inventory is sold. So what you're given here, you first of all write that whatever you're given in note number 1 is what? Is inventory. Then these notes I will give you here are very, very important. I'll give you some notes which will help you to know how to determine carrying amount and tax base. We start with inventory. Now, number 1, if you can be able to recall from what you did in financial accounting, though there is a small topic we're going to do in relation to this in a file, Inventory should be valued in accordance with the International Accounting Standard number 2. Whenever you're determining the value of inventory in financial accounting, you do that in accordance with the International Accounting Standard number 2. And actually, this particular standard requires that the inventory or the value for the inventory should be the lower of the two. Actually, should be the lower of two values, the cost or number 2, the net realizable value. So meaning that this being the value for the inventory, this is the value at which the inventory is recorded in the statement of financial position. Remember, the inventory here we are referring to the closing inventory. Closing inventory, is a current asset. Being a current asset, it goes to the statement of financial position as a current asset. So we record the inventory in the statement of financial position at the lower of the two. And being the lower of, this being the value at which the inventory is recorded in the statement of financial position, this one is the carrying amount. In other terms, we say that the carrying amount of inventory is basically the lower of the two. The lower of the two. What about tax base? What about the tax base of the inventory? A tax base of inventory is basically equal to the cost. That is what you just need to know. Anytime you come across this item of inventory, we just need to know a cost. The tax base is equal to the cost, and basically the carrying amount is equal to the lower of the two values. Now, let's go back to the information which is given in note 1. We are told the inventory is stated in the statement of financial position at the lower of the two values. And then you're told in sentence 2, the company wrote down its inventory by 120 million to a net realizable value. So in that case, you are given the net realizable value, which is 1113 million. But basically, we are told that in arriving at this value, the value for the inventory was written down. The value for the inventory was written down. In other terms, in arriving at this value, the value for the inventory was reduced with 120 million. So what that means is that we are going to use that information to get what? The cost. How do we get the cost? To get the cost, we will take this 1130 million, and basically we add back 120, because in arriving at 1130, the value for inventory was reduced with 120 million. It was written down. It was reduced with 120. So we get what? What do we get here? We try to hurry up. Because of time, I want us to finish this question here. This one will give us, what are you getting here? This one will give us what? Will give us 1250 million. 1250 million. So having that, then we just need to move and basically use this particular concept which I've explained here to determine these two values. Carrying amount, we have said, should be the lower of these two values. Cost is 1250 million. Net realizable value is 1130. We take the value which is lower. The value which is lower is 1130. The tax base is equal to the cost. The cost is what? 1250. So 1250. So then we get the difference. We take this minus that, and basically we will get a difference of 120. And this one is a negative. Once you take this minus that, you get negative 120. So being negative, that one is deductible. Temporary difference. Make sure you indicate whether that temporary difference is taxable or deductible. If you get a negative figure, it's deductible. So we are done with that. Let's move to point number 2. So what is important is this. These notes I'm giving, make sure you are noting them somewhere. So let's move to note 2. Note 2, we are given the trade receivables. Even before we go through that information, there is also a note I will give here that for trade receivables, and this one also applies to the trade payables. So the carrying amount, this one is equal to the net amount. So for example, we know from financial accounting, whenever you're recording receivables in the statement of financial position, you take receivables and then maybe you less things like the allowance or the provision for doubtful debt. So the amount which you get is the net amount. So the carrying amount is the net. What about the tax base? Tax base is the gross amount. It is the original amount It is the original amount of receivables before making any adjustment. Before making any what? Adjustment. Let's go through that point now, having that knowledge. So we are told the trade receivables had a carrying amount. In our case, we already have the carrying amount. And this carrying amount, automatically, this one has to be the net. So there are a number of adjustments which are made in arriving at that what? Value. So we are told had a carrying amount of 450 after making a provision for a general provision for doubtful debts of 30. So in arriving at this value of 450, there's an amount of 30 million which was deducted, and yes, and actually we are told that this provision is not allowed for tax purpose. I think this one is quite simple. So we have the net amount which is 450. How do we get the gross? Who can tell us how do we get the gross? And we try to hurry up because of time. Betty, how do we get the gross? Vincent, Jacqueline, Jane. Tumepewa, we have what? We have the what? We have the net amount. The net amount is 450. Basically, we know that in arriving at that 450, there is an amount of how much? There is an amount of 30 which has been deducted. How do we get the original value? We add back. So basically, that will give us what? That one will give us 480. And this will, we get the difference, which is basically 30, which is negative, and that is still deductible, temporary difference. So what is important? This. So, and I've said that also applies to payables. So then note number 3, we are given note number 3 here. We are given something called PPE. I'll also give a note for that. PPE, the carrying amount, this one is equal to the net book value or the revalued amount based on what you're given. The net book value or the revalued amount, whereas the tax base, this one is equal to something called the written down value. Remember the other question which we did, the question we started with, we said in case you're given an item of asset, carrying